I'm Rick Talley with Netherlands Sewell. Proud to present our next company, Granite Ridge Resources. They're a Dallas-based public, non-operated oil and gas company with assets all across the United States. Here to share their story is Tyler Farquharson, their CFO. Please welcome him.
Morning, I'm Tyler Farquharson, CFO at Granite Ridge. So we're happy to be here. This is actually our second year. Last year when we were here, we were still private. We were going through a de-SPAC transaction last October. So we're excited to be back, excited to be public. We're happy to be able to present to you all today. So who are we? We are a Dallas-based non-op company. We have assets across 5 different basins in the U.S., the Permian, Eagle Ford, Haynesville, DJ, and Bakken. Highly diversified across 2,500 wellbores, 75 different operators, and sorry. We're about $1 billion market cap with conservative balance sheet. As of the end of the quarter, we had approximately 0.1x leverage. Our assets, again, as mentioned, are across a diversified set of basins in the U.S. And we produce about 20,000 BOE per day and reported trailing 12 EBITDA $325 million. So what do we do? We're a growth story via consolidation. So we expect to deliver this year about 13% production growth. And we consistently see a path to deliver around 15% production growth through continued consolidation of the non-op space. So how do we allocate capital? We generally allocate capital three ways. So one, through our ground game. We call this our burgers and beers. Think of these as small, relationship-driven transactions. They're typically short cycle. They're typically either leasing or drilling with near-term development. And they've historically been our focus and our core growth engine. Second way is larger scale acquisitions. These are generally multi-operator portfolios of PDP and diverse operator inventory. They offer less control for us, but typically include more diversified inventory and short to medium term inventory opportunities. The last thing, strategic partnerships. These are larger concentrated investments with single operators. These are asset level, provide a lot more control over development. So a few highlights for 2023. So we're off to a good start. We generated $70 million of EBITDA this past quarter and delivered 13% growth quarter over quarter. We continued our dividend repurchase program, declaring an 11-cent per share distribution, which is about 5.5% yield. And we continued our repurchase program, $4 million this year. That's a $50 million program that runs through the end of this year. Delivery of our wells is on track for the year. So in the quarter, we delivered a little over 5.5 net wells. That was 79 wells across mainly 2 basins, the DJ and the Permian. In trailing 12 months, we've delivered almost 300 wells and 21 net wells turned to sales. So looking forward this year, we expect to generate about $300 million of EBITDA on about $300 million of CapEx plus the $60 million dividend. So we will have some outspend this year, but with our low leverage of 0.1x, we're fine with continuing to invest in projects that achieve our internal rates of return until we get to our target debt threshold. So speaking of that, on the right-hand side of the page here, our cap table as of 6/30. So we ended the quarter with $55 million of debt, had some cash on the balance sheet of 14, so ended with net debt of 41. Again, that was low leverage of 0.13x our trailing 12 EBITDA. Internally, we're targeting half a turn of leverage. We think that half a turn is reasonable moving forward in our space, given that we don't control a lot of the timing of our drilling. So our cash flows can be lumpy, our working capital can be lumpy, so we want to keep our leverage low in order to absorb a lot of those bumps along the way. Currently, RBL facilities $325 million borrowing base with $150 million commitment. So left us with about $109 million of capital at year end, or at $109 million of liquidity at quarter end. On the left-hand side, just a few key statistics for us. Tickers GRNT, based on our 2Q adjusted EBITDA, $70 million. Our leverage, our EV to trailing 12 adjusted EBITDAX is about 3.2 times, or 3.6 times, and 3.2 on a trailing basis. So a little more on assets here. Again, spread across 5 different basins. We've also highlighted a couple different basins where we either historically have had assets or are actively looking. So most of our activity right now is in 2 basins, Permian and DJ. During the first half of the year, over half of our, or actually over 80% of our activity have been in those 2 basins. Also have assets in the Bakken, Haynesville, and Eagle Ford. So we're in the basins where roughly 90% of the active rig count is right now. We obviously like that with deal flow. Also, though, allows us to actively be able to manage where we're deploying capital, different basin ecosystems, different commodities. So we really like the diversification here and what we're able to do in our plans forward. One unique item for us, we offer a ton of great operators. So we have roughly 75 operators that we have interest under. It's roughly split 50-50 oil and gas, but it's also roughly split 50-50 public and private. So we're under some of the best private operators, Mewbourne Oil, Henry, Mewbourne and Henry, and this is something that typical public investors don't really have a lot of access to, so that's something that we think is unique. Capital allocation. So capital allocation is pretty straightforward. Sources for this year, about $300 million plus half a turn of leverage that we're comfortable with going up to for the right deals. We do pay an annual dividend. It's about 5.5% yield. Right now, with where our leverage ratio is, we're not having to pay down debt, but should we get to half a turn, we defend the balance sheet at that level. And then maintain production. So our run rate CapEx burn to hold production flat is about $150 to $175 million. So above and beyond that, we're allocating capital to a handful of different opportunities. So again, our core growth engine is burgers and beers. These are the small transactions. We like to string these together. We like to do 15, 20 of these a year. It really starts to add up. Those types of transactions give us a lot more control over development versus larger scale acquisitions, larger scale marketed deals. So that's where most of our capital goes. We do look for consolidation opportunities of larger transactions. Those are hard to do. Those are highly competitive. We haven't had much success on those, but we do look at those actively. We do have the buyback program of $50 million. Don't spend a lot on this. This last quarter, we spent about $4 million. With our uptick in volume, this is going up, but we'll still shouldn't have any issues with getting to $50 million by the end of this year. Then finally, dividend growth. Right now, we mentioned we have the 5.5% yield dividend. We're not looking to increase that right now. We still see plenty of opportunities in these other areas and would prefer to allocate capital to those. Opportunity set. So 3 items here. So again, burgers and beer. These are our small relationship deals. These are boots on the ground. These are typically $2 to $6 million entry cost, very low working interest. On the backside, there's maybe 2 to 3x drilling capital. So these are leasing projects, drill-ready projects, very short cycle. We're able to get our cash back very quickly, have certainty around development. Next up, strategic partnerships. We're really like these right now. We've launched one in the Delaware Basin. These are partnering directly with a private equity style management team, have deep knowledge of the basin. So we like this because it's a larger investment for us. We're able to deploy more capital through this with a team that we trust, with a team that we also control drilling pace, drilling timing, how many rigs, how fast. So that's something that we're rolling out in the Delaware right now. This could be big for us. So these are anywhere from 20 to 60% working interest. If we get one of these, in a handful of basins, this could easily be $300 million a year of commitments to projects like this that offer us a ton of control over development opportunities. Finally, the acquisitions. We think this is something later on down the road. These are large scale. It's a mix of PDP and diversified operator inventory. So these are interesting, but I think we believe that there will be more traction on these types of acquisitions later on in our life. So deal sourcing, we're very selective on what we look at. We're very selective on what we bid, and we have a very low hit rate. So we see about 9 deals a week. We bid on a few each week, and we win one maybe every 3 to 4 weeks. So we don't win a lot of deals. That's something like 4% over the past couple years. And Permian accounts for over half of it. Again, no surprise with all the rigs in the Permian. So small deals, but it adds up over time. So over the past 10 years, we've deployed over $1.25 billion of capital to these types of projects. You can certainly see in the past handful of years it's really accelerating. So we're having a lot of traction on this, a lot of great returns here. This is, again, will be our core, has been how the company was built, and will be our focus moving forward. A little more on the burgers and beer, so the size of the opportunity. It's a big market. So there's about $100 billion a year of CapEx spending across shales. We think that non-operators have about $25 billion of that. And right now, with us and the other few publicly traded non-ops companies, we only address something like 3% of this market. So certainly not all this is for sale, but there's a ton of it out there. We're seeing a ton of opportunity. And in fact, on the bottom right-hand side of the page, even with reduced rig counts here over the past quarter or so, we're still seeing a ton of deal flow. A case study here on why we like this. So this is a deal we put together in Reeves County, Delaware Basin. It's a farm out and a leasing strategy around some EOG units. It's ended up being about 2,300 net acres. What we really like about this is we're able to get into these locations in the core of the basin for a very attractive entry cost, $800,000 a location. So we spent something like $16 million to get roughly 19.8 wells, to get 19.8 wells, which is roughly 1 year's worth of development opportunity for us. So we think through our burgers and beer plan, we can continue to replace our inventory and then look for larger strategic acquisitions to really build some scale. Strategic partnerships. Why this opportunity exists is really because of private equity funding has really been a challenge these past handful of years. So there's less teams getting funded, but there's really good teams out there. So a lot of these teams are now looking for alternative sources of capital. They're seasoned teams. They know how to make money. They're proven money makers. So we're really interested and excited about this style of partnership where we recreate a private equity-like return for those management teams, but we do it at the asset level. So there's no, control aspects as far as, buying or selling your company. There is control at the asset level, but there's no control over the company. We're not on their boards. We don't tell them what to do. So this is something that we're super excited about. Again, we've got one that's done right now in the Delaware, and we're looking for more opportunities like this in other basins. So finally, we get asked this a lot, the acquisitions. I think this is farther down the road for us, but there's a ton of assets that are held, non-op assets that are held by private companies. So on the left-hand side, you can see it's barely addressed by what's gone on so far with public acquisition or M&A. On the right-hand side, we've identified 67 different groups with about $16 billion worth of estimated assets. And a lot of these live inside of fund-style structures where they have to sell. So this is something where we think if we can be patient, we can be opportunistic here and really add something that really increases our scale. But again, this is something that's, not an every year thing for sure, probably, hopefully maybe an every other year, every few year type transaction, but it's something that we keep our eye on. So last thing, just guidance for the rest of the year. So we've updated our guidance. We reported earnings last week. So right now, guidance range for the year is 21,500 to 23,000 barrels a day. We're roughly half oil. We think we'll spend roughly $300 million a year, including $50 million of acquisitions, and generate roughly $300 million of EBITDA doing so. So production growth at 13%. We redeploy all our capital plus a little. So we'll end the year with something like $50 to $75 million of leverage on our facility, but still well below our target leverage of half a turn. So we've added some other slides in here just as appendix slides. Certainly won't go through them, but appreciate your time today. Thank you.